Hello everybody and welcome to Module 1 of our 15-week accounting course. With this accounting course, we're covering the topics of both financial and managerial accounting. We're covering it in one course, however, and it's geared toward MBA students that are coming in that need a basic understanding of accounting and how it impacts business, but it's for those that are not really planning on going into the accounting field. We don't go into quite as much depth on some of the topics as we would in a standalone financial accounting or a standalone managerial accounting course. So we're going to go through the materials in this 15 modules, and each module, depending on the length, might be broken into two sections to keep them about every half hour, 30 minutes per module or per section. That's the goal there, to make it easier to consume the material in a reasonable amount of time. So Module 1, we're starting off and we're covering the intro to accounting concepts and principles. Now I will say out of the 15 modules, about 2/3 of them are going to be financial related and the last third will be managerial accounting related. But the goal is to cover everything, again, that an MBA student needs to continue on in their business courses. So for the agenda here, we're going to talk about an intro to accounting and the users and what they need, a little bit of history. We'll talk about the different classifications of accounting and the careers within them. We'll talk about, again, some history of accounting, the accounting concepts and principles that really drive how we measure things. We'll talk about the 4 core financial statements in their proper order. And then to set the stage for the next module, we're going to be talking about the basic and expanded accounting equation. So first of all, what is accounting? It's often referred to as a system that allows us to identify certain transactions, certain economic information about a company, measure it, identify a way to measure it, and then communicate it out to the users, which would generally come in the form of a financial statement or various other statements. So it's a system that allows us to identify and measure information and then eventually communicate it to the users. Now, when I say users, who is the information being communicated to? We have 2 main classifications that we could talk about. First, and what we're going to spend our time with financial accounting talking about, would be the external users that have no other way of getting information about the company. So these would be stockholders, investors, creditors, the government. And then we have internal users, which would mainly be management. They're using information to make decisions about the company. And we're going to see that in a little bit more detail in the next few slides. So we have managerial versus financial accounting. As I said, this course covers both topics. Now there's one topic, cost accounting, that actually goes into both areas. It's when we talk about inventory specifically, we see how it links between financial accounting and managerial accounting. Again, more of that will make sense as we progress. So now we're going to take a look at some differences and similarities in accounting, in the 2 types of accounting. Who uses the information, first of all? Financial accounting is generally for external users. The standard financial statements are pretty well prescribed across the different companies, so investors know what to look for with those. And again, it's pretty high-level information. We'll see that. Managerial accounting is used for internal users. So that's a question of who uses the information. Management uses managerial accounting. Makes sense there. What types of reports? So with financial accounting, we'll actually spend quite a bit of time talking about the 4 core financial statements. And as I said just a bit ago, they're very well prescribed. The requirements for how they're completed are fairly stringent. There are a couple of options, but for the most part, if you pull an income statement from one company and compare it to another company, the overall design is going to be pretty much the same. So that's financial accounting. We have 4 financial statements. Managerial, on the other hand, there's really no limit. There's some that resemble financial statements, but it's from an internal perspective. And there are many software suites that have customizable reports for various purposes. You're going to see just so many different types of managerial accounting reports, and it would all depend on the type of the company you're in, what information they deem is relevant, and really that manager specifically what they want to see. So a lot more flexibility in the report styles. As far as time periods, financial accounting, we're certainly mainly talking about annual statements, but also quarterly statements become important. Those are, for a publicly traded company, those are the two absolute requirements. You might occasionally see completely unaudited monthly financial statements. It's absolutely not a requirement, and it's fairly rare. But for managerial accounting, you'll see anywhere from, the year down to the quarter, the month, week, day, even sometimes hourly or real time for certain types of statements. Obviously, running an income statement on a real-time basis doesn't make much sense, but running things like a labor report, knowing who's working that day compared to the sales that the store is generating that day, certainly becomes important. And when we get into the different types of standards, we'll see that financial accounting, they are held to very stringent standards. We'll call that GAAP. And generally accepted accounting principles is the term for that. The reason they're so stringent is that they want to make sure the investors are getting accurate information that's not been spun. For managerial accounting, there generally are not any standards that are absolutely required, but there are certain situations where that managerial accounting information needs to be used by external parties. They might require certain types of standards. For example, the field I'm in, Medicare auditing and Medicare accounting, we deal with healthcare facilities and the rules that apply to the Medicare program. We use a lot of the managerial accounting information that's within the company. We use that to determine how much cost reimbursement they should get from the government for their Medicare services to patients. So there are Medicare regulations that apply, Medicare policies, and then again, there are other types of standards. If an insurance company needs to see your cost information, they might be looking for your compliance with Cost Accounting Standards Board requirements. Those are all outside of the scope of this course, but those are just some additional things that might apply in certain places. Now, as far as careers in accounting, so this is more certification, but it also relates to what career you might be in. When I first got into accounting, my very first, semester, my eyes were opened by this. I really didn't understand that when you hear the word accountant, that it's not just one type of field, one actual job type. There are so many different types of accountants. Not a whole lot different than how when you hear the word doctor, the title doctor, there are many, many, many types of doctors, many types of specialties. It's a similar type of thing. So we have financial accounting, which we're dealing with financial statements, the preparation of them. We have a certification called the Certified Public Accountant, CPA. Managerial accounting, working within the company, helping them to use that information to make better decisions about the company. You have a Certified Managerial Accountant, a CMA. External auditing, or also known as public accounting. So this is where we have auditors reviewing the information put out by the company and determining whether or not it meets the GAAP requirements before investors take a look at it. This is also a CPA certification. You have internal auditing, which is people within the company doing that secondary level of review, helping to make sure there are no fraud or incorrect information, fraudulent or incorrect information within the company. You have a certified internal auditor certification. Now, the one probably most people are familiar with is taxation, doing your tax returns. Now, this could be a variety of certifications. CPA tends to be a pretty strong one here. They have various ones related to just taxation itself. And then a rather unique field, and I'm kind of partially involved with this with the Medicare auditing and accounting, but it's government and not-for-profit accounting. So following the rules of the government for information for citizens rather than for investors. Now, a couple other fields in accounting. Education, certainly a lot of, again, you got to train people that are involved with all these other areas. And then we have a growing one in recent decades, and it's kind of unfortunate that it has to grow, but it relates to criminal activity. So it's fraud accountants, forensic accounting, basically identifying that fraud has occurred and gathering information necessary to make a case and prosecute that fraudster. So now we'll move on to a fairly brief history of accounting. We're not going to spend a whole lot of time on it. I've got other videos out there that go into more detail on this. But accounting evidence has been found back 7,000 years. Now, again, when we're talking 7,000 years, we're talking extremely rudimentary, basic information. But it's basically tracking certain things like crops, crop yields, or herds, things like that. Money in its current form obviously didn't exist back then, but there was more bartering involved. There was just more tracking of crops and, again, herds of cattle or herds of animals. So that's where you first start to see humans tracking things like that. Fast forward quite a few years, and we have the double entry bookkeeping system, double entry accounting. This is the model we use even today. Later on in later modules, we'll talk about debits and credits and the balancing of accounts. It's the same basic model that was first identified or first communicated in a text back in 1494. So very long time ago. Fast forward quite a few years again, and we have the first real standards, at least in the United States, that were created around 1932. And these were created in response to the stock market crash, which of course led to the Great Depression. And the idea here was that investors are relying on this information given to them by companies, and they really have no way of verifying it themselves. So we need to ensure that it's trustworthy information, that it's been verified. And these standards set the rules, but they also put in place the auditing requirements, some of the basic auditing requirements. So we have a first agency that was put in place here, Securities and Exchange Commission, and the SEC. It's a government agency that oversees the setting of accounting standards, and we'll talk a little bit about that later. Actually, we'll mention it right here. Even though the SEC oversees standards, they don't actually set them themselves. Instead, they've delegated that over the years to different boards and committees. But right now, for the past few decades, it's been with the Financial Accounting Standards Board, the FASB, and they promulgate the GAAP requirements, generally accepted accounting principles. So when you hear somebody say GAAP requires this or GAAP requires that, we're basically talking about what the rules tell you to do for accounting. I've put in here a little link if you wanted to find more about the FASB, and again, I have additional videos on this in more detail. Now, we have another board that is called the International Accounting Standards Board, IASB. They set standards that are used globally for virtually every other country. The United States has not yet adopted them, although the FASB and the IASB have worked together over the decades to try to get closer and closer to converge their standards together. Moving over to auditing. Now, auditors, a simple way of explaining what an auditor is, it's basically the secondary reviewers of accountants. So they look at the information, they make sure the company is following the proper requirements, presenting the information fairly so that investors can make decisions. Now you have the Auditing Standards Board that is an arm of the American Institute of Certified Public Accountants. So you have essentially the accounting agency, the accounting professional organization that is setting their own standards for auditing. So that's been going on for quite some time until the Sarbanes-Oxley Act of 2002 was passed. This was passed after a string of fraudulent financial statement and scandal situations such as Enron, WorldCom, Tyco. There were just several in a long string of companies that had fraudulent financial accounting statements, a lot of unethical activity. So this was passed, requiring much more stringent standards on the auditing side, as well as the review of internal controls. And we'll see a little bit more about internal controls in a later chapter as well. But SOX, as this is often referred to, now requires that a board called the PCAOB, Public Company Accounting Oversight Board, sets standards for publicly traded companies, sets auditing standards. So the Auditing Standards Board still is in place, and it still sets standards for non-publicly traded companies. The PCAOB from SOX, they have adopted most of those auditing standards board requirements, but they also set newer standards for those publicly traded companies. So now we'll move on to a topic that's important to understand as we get later on into accounting. This is basically the accounting concepts or principles or assumptions. Now, what I want to mention here before we even get started, we're going to see the name of these various quote-unquote principles. I'll just call them that generically for right now. We'll see several of them in the next few slides. Some of them are commonly referred to as principles. Some are commonly referred to as concepts or assumptions or constraints. However, depending on which textbook you look at and where you see the information, sometimes in one textbook a thing might be called a principle, in another it might be called a concept. My point here is what category you give it for this situation really doesn't matter. It's understanding what the name of that is. When you see the name, whether that's called principle or concept, when you see it, do you understand what it is kind of getting at? You don't need to memorize a definition, an explicit definition for it. Just understand the idea behind it. So I'll explain in a little bit. We'll see what we're talking about here. So one of them is called the accounting entity. Now again, you can call this a principle, a concept, whatever. It's about the accounting entity. This basically tells us that as an investor or a creditor, we want to know information about the company, not so much the owner itself. So if the owner of that company has several mansions, has a bunch of vehicles, they have a hefty bank account, that doesn't really tell us anything about the company because the company is separate. The assets and liabilities are separate from the owner, and investors want to see the company's assets and liabilities. Now, if the owner has invested money into the company, that becomes the funds of the company, so we certainly see that, but it separates it from all the other items that the owner might have. Same thing with a parent versus a subsidiary or just different departments or divisions of the company. We want to have a way to break them out so we can see what the assets and liabilities of the parent are versus the various subsidiaries. So it's all about what information is relevant to the user to make decisions about a certain thing. We have consistency or comparability principle, concept. Again, whatever term you want to give it, doesn't really matter. But when we talk about consistency or comparability, this is somewhat of a soft requirement. And what I mean by that is that it's not hard and fast. This basically says whenever possible, we prefer that you follow the same measurement techniques. GAAP has a few different options for certain things like inventory, depreciation, just how they record things. There are certain methods they can use, they can choose from. This consistency and comparability requirement essentially says use the same method from year to year when possible. We don't want you using, I'll just throw out some names here. We don't want you using FIFO for inventory one year and then LIFO the next year. Now, again, in later topics, we'll see what those mean. But if you use them, the numbers are just by their nature going to be different because you're measuring them differently. So if you try to use one method one year and a different method the next year, investors are going to see changes and not realize that it's solely due to the way things were measured. There are certain ways that a company can change their method, but when they do so, they have to disclose it very clearly to make sure everybody's aware that they've changed methods. And generally, they have to go back to those earlier years and restate them as to how they would look under the new method so that you can still compare year to year. Going concern concept, which is often referred to as a going concern assumption. And the reason for this is that when we're performing accounting for a company, we have to assume that this company will continue to exist indefinitely for the foreseeable future. And the reason for this is that we are making a lot of long-term transactions that are spread out over multiple years. If we really don't believe this company will exist for 20 years, we can't do a long-term transaction that's going to spread out over 20 years. It would make no sense. So this assumption holds true unless there is very clear documentation to the contrary. And in that case, the accountant and the auditor must clearly disclose and document why they just really, really do not think this company will continue to exist in the next year. So it's all about that next period. That's as far out as they generally look. The conservatism principle basically is telling us that we want to make sure not to give overly optimistic information that we can't support. Now, we don't know the facts about everything. There are a lot of estimates in accounting, but when you're using an estimate, give a conservative estimate. Give the kind of the worst case scenario there, the worst realistic case scenario, as opposed to some pie in the sky best case scenario that likely won't happen. That's what conservatism is all about. Materiality. Now, what we're basically saying here is investors are concerned with what information matters to their decision. So from materiality perspective, we're trying to identify, we realize that we're not going to be perfect. Accounting, surprisingly, is not a perfect science. There's a lot of cost to tracking and measuring certain things, and we're not expecting everybody to be perfect. However, if there are material or big mistakes that are made, that's what we're trying to prevent against. If there was a mistake made that is so big that it would impact somebody's decision, then we have a problem. If it's a mistake that's just $1 or $10 in total for the entire year, nobody cares about that. Nobody's going to have an issue. That's not going to impact anybody's investment decision. Materiality often depends, or it generally depends on the size of the company. If you have a multi-billion-dollar conglomerate, then sometimes even, thousands themselves won't matter. Sometimes even a small amount of millions, just depending on the situation and the context, may not matter as much, but certainly the hundreds and thousands wouldn't really matter. In fact, things are usually rounded up to the nearest thousand anyways, so little minor errors like that just don't matter. The thing with materiality is that you want to analyze the costs that are required to get that information more accurately stated versus the benefits that would be held for investors or creditors. So would they really value that additional information? Would they think it was worth the extra cost the company incurred to get it? Here we have full disclosure. Now, the full disclosure principle basically says that we want to make sure the company is presenting all relevant information. They're not leaving out certain things. So we want the truth. We want the whole truth. And this is really what full disclosure is all about. And, of course, nothing but the truth. But it's make sure to be clear and transparent. Objectivity. This is basically saying we prefer fact-based evidence whenever possible. We don't really like estimates. We understand that they have to exist sometimes, but we'd prefer fact-based and again, objective information. Not somebody that has a conflict of interest that they might spin the information. We want the information as it is, the facts. The monetary unit principle, or unit of measurement principle, is basically saying that in accounting, for financial accounting at least, we want the financial statements measured in some sort of monetary unit. For the United States, that would be dollars. Of course, we'd have different currency for other countries. But the point is we want it measured in a monetary form, as opposed to pounds of materials, units of product, hours of labor, things like that. We want a dollar amount. I will back up for a second. This one, for managerial accounting, yes, we still have dollars, but we also do record certain things in certain reports as materials, hours of labor, all of that. This concept, monetary unit, only applies for financial accounting. The historical cost principle is basically saying when we're recording an asset, or for that matter a liability, generally speaking, we're recording the original purchase price. We don't want to update it to some new fair value. That's really what this is getting at. There are certain exceptions to this that have evolved over the years, but generally assets are recorded at their original purchase price. The time period principle, also known as the periodicity principle, basically says that we don't want to record the entire life of the company in one big period. We don't want to have 20-year financial statement. We don't want to wait till the end of this company's life before we report any of our income statements. We want to break it into various periods, months, quarters, and years, so that we can have a status update every so often, but also we can compare 1 month to the next month, 1 year to the next year, things like that. That's all we're saying here. And then we'll end part 1 of this module with a discussion of a very important topic, the accrual concept, and that's in comparison or contrast to the cash basis of accounting. We'll definitely spend much more time on that later, but basically what we're saying here is for the accrual-based accounting, we record revenues, which is through the revenue recognition principle. We record those when they've been earned. Regardless of whether we received cash at the same time, maybe we received cash earlier, later, that does not matter at all. We record the revenue when it's earned. When did we deliver the product? When did we provide the service? For the expense recognition principle, also known as the matching principle, we record expenses whenever possible in the period that the corresponding revenue was generated. In other words, if we generated some revenue, but we had to use up some inventory, we had to use up some salary expense to generate that revenue, then hey, let's record those expenses that same period as the revenue. We might have bought that inventory 3 years ago. Crazy example, I know. We might have bought it 3 years ago. We would not expense it then. We'd wait until we sold it and generated revenue to record the corresponding expense of using that inventory. So that takes us to the end of part 1. We'll take a quick break here. We'll have a second video coming up with part 2 of module 1. So again, the idea was to break these down so they're about 30 minutes apiece to make it easier to digest this information. So let's take a break. Go ahead and click on the next video 2, and we'll start with that shortly here.